Hey guys, it's Max Convexity. I hope everyone's having a great day so far. Today I wanted to post this interview I did with Howard Chan about a week ago, a little bit more than a week ago. Howard is the CEO and founder from Kurv Invest. He's a pretty interesting fellow, and I had a nice talk. We spoke for about 30 minutes. Unfortunately, I did not record my side of the conversation, so we could only hear Howard talking. So that works out better because we don't have to listen to me. Unfortunately, I have to go back and dub the questions in. So I'm going to do a reaction video to my own video, if that makes sense, which it really doesn't to me that much, but I don't know what else to do. Other than this, Howard, if you're watching, I want to get you back on. You have a new fund coming out, KQQQ. I believe that's the ticker, and I can't wait to hear about it. And he was teasing that fund in this interview, but he couldn't tell me about it yet. So you'll hear him referring to a fund. Well, anyway, there's the Kurv is still kind of teasing the fund, and they aren't giving us all the details. But I got on the SEC's website, and I have a few details. So I'll be making a video on what I found out soon, and I'll try to get Howard back on to talk about the new fund. But we had a nice conversation. Let me play it for you.
Sure. My name is Howard Chan. I'm the CEO and founder of Kurv Investment Management. We are a group of folks who formerly have worked at some of the larger asset managers. In fact, in creating Kurv, I actually asked a lot of my former colleagues. I used to head up the ETF business at PIMCO in Europe for almost 7 years. So I asked all the folks that I really enjoy working with whether they would join me in this sort of new venture. And I'd say 80% of them at Kurv right now are former colleagues that we've worked with. So we have a pretty knowledge about ETF and various different strategies. The reason we kind of formed Kurv is actually, we've worked with some of the largest pension funds and ultra high net worth individuals. And we just noticed that there's a lot of strategies that aren't really available for everyone. And especially many good strategies are very non-tax efficient. And the reason it's fine for them is because they're non-taxable entities, right? Pension funds and endowments, they don't have to pay taxes. But as soon as you move these strategies into taxable people, then it becomes not as good. So I think for Kurv, when we think about our strategies that we put out, usually has 2 or 3 of these qualities. One is we think about taxes and how it affects the strategy itself. We generally use derivatives and option-based strategies. And then we generally have some sort of cross-asset class. So options and equity, or options and fixed income, or equity and fixed income, something like a mixture to bring the best sort of investment outcome for our investors.
All right. Well, next I asked Howard to tell us about the funds that he has out right now, the 6 funds that Kurv has right now.
Correct. We have 6 single name cover call ETFs. We are on the verge, and maybe I'll come back, on the verge of a few more based upon feedback and from clients. So that's coming up. So we have a existing 6, hopefully soon a few more to come. Yeah.
Next, I bug him to try to give us a fund of funds. And he laughs at me.
We have heard that is the most consistent feedback that we have gotten. I think we one of the funds does address that, but I think we're doing it in a different way than people expect. So I will say we've heard it loud and clear, and what we wanted to do, we wanted to rethink how, I would say, how we can use our funds in a way that is not being currently used on the market. And just as maybe a caveat, we launched the first 6 sort of as tools. So, these cover call strategies generate a lot of distributions, and they generally were used by ultra high net worth individuals to generate, income in their portfolios. We launched them as a means for advisors and their clients to get access to these strategies very easily. But it ultimately depends on the advisor to decide what exposure they want, when they want to use it. So I think many people, when they ask for funds of funds, it's like, well, I don't necessarily want to make the decision of how we use it, when to use it. I will delegate that to you. So we hopefully will have a strategy that can actually answer that question.
Okay, next I asked him about covered calls generally and what's the advantages of doing a covered call and income option trading generally, and give us a lesson or his takes on it.
Yeah, I think there's 3 dials. We actually wrote a piece on this on our website. I use the kind of analogy as being a DJ. You have 3 dials that you can tune in any cover call strategies. The first one is, what is the out of moneyness that you calls on. So you always have, as a portfolio manager, you always have a trade-off, right? The closer you write to the spot price, your strike of your option to the spot price, you generally have higher yield, but your probability of being successful, basically getting making sure that your option expires out of the money, is lower. Versus you write your strike further out, you have a higher probability of it, fully expired out of the money, and so harvesting the full premium, but your yield is lower. So you always kind of want to find that sweet spot. So that's the first dial. The second dial is which one is actually not used a lot, which is how much of a cover calls that you actually write. So you could write 100% notional of cover calls to maximize your yield, but you give up price appreciation, right? You can write cover calls only on 50% of your portfolio, leaving the other 50% to fully rise for price appreciation in an upward market. So that's sort of the second dial. And the third dial is the expiry of the options. So now the option market has a lot of different varieties of expiry. We know there's like daily expiry, there is weekly, there's monthly, and there's even yearly. Again, there's trade-offs there. So the shorter the expiry, you could potentially generate more yield because, for instance, a weekly you can write 52 times a year. A monthly you can only write 12 times a year, right? And annually you again write once a year, right? But it's what is the probability of your spot your option expiring out of the money, right? So the more you write, the probability goes lower. So you again want to make that trade-off in your strategy.
Okay. Next, I was asking them how far out of the money they decide to go. Is it based on delta, or is it based on how many percent? Is it based on 2% of the money or 3% of the money? Or is it based on delta?
Yeah, and so you're exactly right. Generally, where we write our calls is about 25-30 delta calls monthly. They're actually 5 to 6 weeks, but we roll monthly, and that's because we look at the historical past and then the current vol environment. That's where we currently find the sweet spot, where and what that translates to is about 5 to 15% out of the money. So the range is based upon the volatility of the underlying. So if your underlying is Apple, which is generally less volatile, it's about 5% out of the money. And you want to make sure you're out of the range where you generally can have the call options expire out of the money. But if you have a more volatile underlying, such as Tesla, a $30 call would be around like 15% out of the money.
Okay, well, next I say, don't weeklies give you less path dependency and make your odds higher and give you more income? I didn't understand what he was saying about the chances of expiring out of the money. So I give him a chance to explain that again.
Yeah, so there's path dependency in options. We We generally write, as I mentioned, 5 to 6 week calls and roll monthly. That has been where we think the current sweet spot is. But if the volatility regime in the market changes, we may change where we write the options, adapting to what market environment with. But so far, we've kept to the 30 delta in general, monthly calls in our funds.
Next, I ask him if he holds back some of the distribution or if they just pay it all out.
Yes. So I think one of the few features about our funds that we try to manage is we do try to look to. We know a lot of people use these for distribution and income, to supplement their income. So we try to make our distributions as stable as possible. So in that sense, we think we've kind of met our goal on that front. The other part is that we wanted in our funds to have a balance between price appreciation and the income that's being generated in our funds. And that's why we write a bit out of the money calls in our funds, so that if the stock does rise, there's some room to rise for the price appreciation. And so generally, if you look at our funds, we've tracked the underlying well up to, when it hits the strike, that's where, again, I think most people who use covered calls should be aware that you are trading off some of the upside to generate the income. So as long as it doesn't hit that strike on the top of the call, we've generally have pretty good room for price appreciations in our funds. Yeah.
Well, next I asked Howard about doing covered call spreads instead of covered calls, and I tell him why I like those better, and I try to convince him to do
Max,
those.
you're getting into what's coming up. So, no, we definitely. So what I will say is this, right? I think, and this is as somebody whose firm has 6 cover call ETFs, right? We intend these to be tools, but cover calls shouldn't be used in all market environments, right? I'm kind of speaking against but I think people should be aware. There are moments where cover calls works really great, and then there's ones that, so for instance, we have had a pretty strong price action in like NVIDIA this year, right? And I would say, when you do have a perspective that maybe there is price appreciation, you don't necessarily want to cap that. So you would probably want to do it uncover. You just want to hold the stock, right? And by the way, you could get higher yield with NVIDIA, right? But your decision is, do I want the price appreciation, or do I want to have the higher premium that's got, because, people are looking for call options, so the premium is higher there. But in instances where, for instance, you have other names like Tesla this year, which hasn't done very well, that's actually a pretty interesting place to have cover calls, because as the stock slides, your calls generally are expiring out of the money. So you're really harvesting the full amount of premium from your call options. So it does, again, this is the decision that the investors have to make. Some don't want to make those decisions. So, we're trying to address that, hopefully, in the future product. Yeah.
Well, I asked him one more time about using call spreads. You know me, I like these call spreads. So I don't remember exactly what I said, but we go back and forth a little bit more. I guess I'm giving him a lesson on options. Don't you bet these professionals just love it when these amateurs talk their ear off on different strategies. I'm sure they just love it. Jay and Howard are good sports, though, to put up with me. I appreciate him.
Maybe in the new funds, we actually have the discretions. So it's market dependent. Yeah, yeah, exactly.
I finally got him to agree. That was the question. I finally got him to agree, maybe on some call spreads, or maybe on not overriding 100% of the portfolio. You know me, I always want the upside uncapped. So he finally said it'd be market driven, or they're going to leave themselves open to it, to call spreads, or uncapping the upside in some manner. And then we talk about, is this model driven or discretionary?
No, We have done back tests, and then we're generally model driven. So, you know, we have tested. So how we arrived at the fact that we write 5 to 6 weeks options and roll monthly, and then at 30 delta, right? That is very specific. It's actually because we have looked at a lot of historical data, and then also looking at the current environment. We're pretty model driven, so we want to use data to inform us about how we write the calls. So I would say pretty systematic. Yeah.
I didn't say it at the time to him, but when I get Howard back on, I'm going to ask him again. But I think he may be a tasty trader, and I'm just joking. I don't really think he is a tasty trader, but the people at Tasty Trade use something called tasty mechanics, and it's a little kind of best practices they use when they're selling spreads or when they're trying to gather premium. And that's part of their best practices is exactly what Howard's doing, is using monthly options, but you put them on about 6 weeks out, 5 or 6 weeks out, and you take them off with about 14 to 20 days out, 2 to 3 weeks out. And that's, it's been a long time since I watched Tasty Trade. I watched them every day in 2020, 2021, but those are tasty mechanics. And no, I don't think Howard's copying off Tasty Trade, but next time I'm going to ask him if he's aware of that or if anyone else has made that comment. Anyway, Tasty Trade does have a lot of back test, and it is a very tried and true method. The tasty methodology is definitely tried and true. Next, I asked Howard if his fund can take defensive measures. Are they able to go to cash if they need to, or can they go short, or are they just always going to be long and always going to be selling covered calls one after another every month after month after month?
We can go to cash. We have the discretion to not write cover calls, but I'm not sure. I think, you know, we launched these ETFs, so it's as tools. So I think when people are expecting there to be a cover call, but I think also when there is a down market event, the implied vol actually goes up. And so the premium actually goes up. So in some ways, that is a good time to also write calls in the fund. So yeah.
All right. Well, next I talked to him about using shorter term options again. I asked him, can't you make more money, more yield if you use weeklies instead of monthlies?
Right. And part of the reason why we do a longer dated option is that if you think about mean reversion, the market actually rallied back quite quickly. So you were able to, the call still actually expired out the money, and you were able to harvest the full premium over that period. So it was we have looked at those stress scenarios and see, of course, you can't prevent every stress scenario. Like if, the thing with finance is like, if you expect it, it probably won't happen. It's probably something unexpected that will happen in the market. But exactly. So we do try to, I think we just want to be careful and systematic about our strategy. We don't, blow up, or we want to have a steady, things that I think in general, if our investors can predict or anticipate or expect what we do, I think for them, it helps them risk manage their portfolios. And, again, that's why we also want to make sure that our distribution is consistent, because that's a lot of people calculate their monthly distribution based upon, the yield on the different investments in their portfolio. So we want to be predictable on these tools that ETFs. Yeah.
Next, I ask him if he has a certain percentage that he holds back. How do they have a formula to pay?
We do, actually. So not much, but we do have a bank that we keep track of. So one thing I should mention is that we only distribute the premiums from the call that we write in the strategy, largely because we want to make sure we don't end up having NAV erosion. But even there, with the premiums from the call, we do hold some back because we want to mitigate the distribution. So, we don't target a particular yield. So our premium is based upon what the market gives us, right? What the implied vol is in the market. So to smooth some of the distribution, we sometimes will hold some of the distribution. And in months where the market maybe implied vol is a bit lower, we can use up the bank so that we can smooth out the distribution. Now, that only helps us when on the names that are pretty predictable. There's names like Tesla where the implied vol goes, we can smooth it out only so much. And then you'll see basically on our distribution, pretty lower vol names, the distribution is actually pretty smooth. In the higher vol name, there's more variety, but I think it's still smoother than, what one would expect from the market. Yeah.
Next, we talk about taxes. We talk about return of capital.
Yes. So again, I think when I started this, we said we wanted to think about taxes in our strategy. So there is actually a interesting tax treatment for single stock options. So as all of us know, who are U.S. investors, taxes usually get divided into ordinary income, long-term capital gains, and then this third bucket, return of capital, right? So most distributions comes in the form of interest and dividends, and those are taxed at ordinary income. So if you're just using the highest tax bracket, that's like taxed at 37% marginal tax bracket. Then if you hold a security for greater than a year, then you can have a lower tax bracket. The highest bracket is 20%, right? But there's a third category, which is a return of capital. So what happens in our funds is that at the end of the year, when we have sorted out the gains and losses, a lot of the premiums actually, after that, is considered a return of capital distribution because your underlying, the call that you're writing is a similar asset. It's sort of this straddle rule that exists in the IRS tax code. And so what happens is that the portion of the distribution that is categorized as return of capital does not show up on your 1099 div or 1099 interest form. So it's not taxed on your tax return. What happens is that the brokerage that you use will decrease the basis of your investment. So if you bought a security at $100 and $5 is a return of capital, at the end of the year, your brokerage will say you bought it at 95. So now, if you hold that for a year, that $5 becomes long-term capital gains. It's actually not ordinary income. So you're saving 17% of the, whatever the tax difference is on the highest marginal thing. And if you hold it for longer, you're essentially compounding your distribution, right? Because you're not paying that taxes until you sell your investment. So essentially what you have here is you have a tax deferred quality like a IRA in a taxable account. I have to give the disclaimer. I'm not a tax person, right? So like in my use case, that's essentially what it kind of models in a taxable account. So everybody should have different tax positions and they should consult their tax preparers and et cetera. But so going back, so that's really sort of a tax advantage that people have with these strategies. The distribution that's considered return of capital. Yeah.
Okay, next I asked Howard to give us some hints on the new fund. I'm pumping him for some information, but let's see if he takes the bait.
I can't talk about them, but they are filed with the SEC. So the name is out there, but I would love to come back and talk to you more about it because we think it's actually a very cool way to think about cover calls, a different way, one that I don't think we have seen in the market yet.
Next, I asked him what his favorite max convexity video was or is, just to see if he watches my station.
No, I saw a few of your videos on true yields, and I thought those were great, because I do think the dials is important, because depending on how often you write your calls, there's different risk, and then you have to kind of do equate the different distributions. So I think that's great.
That really flattered me when you knew about the true yield video, but because I thought that was one of the better videos. And the Kurv funds, his funds test really good with that metric. They test really well with that metric, I should say. So I think that's also why he likes it. I need to make a follow up on that video, but basically I just asked him to come back on when his new fund comes out. And now this has been a week and a half or something since I spoke with him. I plan to get him on maybe next week. I think that would be awesome. Hopefully after he sees this, I'm sure he'll contact me, or maybe I'll contact him, but we will get him on just as soon as possible. Howard's a great guy, and I really enjoyed speaking with him. Thanks for tuning in, guys.